Hi, welcome to a video on the calculation of present values or future values of annuity streams. We'll work three cases. I encourage you to choose between the following: either work case one and then come back and watch the video, and then work case two and come back and view the video, and then work case three and come back and then view the video, or work all three and then view all three videos. Your choice. So in this first case, we have Scott Moore, a 22-year-old that is on January 1, 2024. On this date, he accepted a position in public accounting and decided to begin saving for retirement. His plan is to invest $2,000 in an IRA annually, which will give him a nice tax benefit. Those tax benefits are one and potentially two. The first tax benefit of an independent retirement account is that all the earnings on your investments, and believe me, there's going to be a lot of them because the money's going to be in there for many years, they're all the tax deferred. You pay the taxes way down the line. Unless you get a Roth IRA, which has yet other tax benefits. You'll learn more about that in tax class. So either way, there's tremendous tax benefits associated with individual retirement accounts. The other one is you often get a state tax deduction for your contribution into your individual retirement account. So all kinds of tax benefits. This particular IRA investment is going to pay a 10% annual return on investment. That's an assumption. Scott will make his first contribution on December 31, 2024, and then do so every year for 40 years. The question is, how much will he have in the retirement account at the end of the 40 years? Okay, so go work that case. I've got the check figure there for you. Please, as you use the check figure, use it. Don't work towards it. Just do your work and then check. That way it's there for your help, but you can potentially harm your learning if you're working towards the check figure. Okay, see you in a moment. All right, welcome back. So, in this case, I hope, by the way, that you got this value, and then you can just view this casually to see if I say anything that might further reinforce your learning. We're talking about the future value of an annuity flow, a series of 40 payments of equal amount, 2,000, with equal time intervals every year. So it's times the future value of an ordinary annuity table factor for 40 years at 10%. That is 2,000 times 442.59256, and that, of course, came from the 10% column going down to the 40 years, and that value is 442.59256. And so that $2,000 payment every year is going to grow into a nice nest egg for you of $885,185.12. You probably already figured out, hey, this is very similar to the question, what payment would I have to make to have $1 million in there? And as you recall, it was in the 2000s, which meant it just at 2000, this was going to be a little less than $1 million, but still a nice nest egg if you just do the 2000. Okay? So let's look at how we would do this problem with the financial calculator. We would input 2,000 is the payment, 40 N, 10 interest per year, 10, and that's 10% interest per year. Compute the future value, and you'll get that same value. Finally, of course, you can use Excel. Here's what I did in Excel. There's that answer again, and there's the keystrokes I inputted into the cell. I used the equal future value function, and then it required me to enter the rate. Indeed, it prompted me to enter the rate. 10%. The number of periods, 40. The payment, I put it in there as negative so that it would return those are my outflows, and that'll be my inflow in 40 years, or shall I say Scott Moore's of 2,000. The present value is 0. There's nothing in the account right now. And then the type of the annuity is ordinary. We're going to make it at the end of every year, and then it'll grow all the way till the last payment at the end of 40 years. And those series of keystrokes minus the quotation marks, which allowed me to put up the formula, returned that value in the cell. All right, let's go forward to case 2. If you haven't done so already, please work case 2. Okay. Jana Moore is 62 years old on January 1, 2024. On this date, she retired. Under the terms of her defined benefit pension plan, you'll learn what defined benefit and defined contribution pension plans are in your education, in your accounting class, specifically Financial Accounting Reporting 3. Under the terms of her defined benefit pension plan, she's able to receive $100,000 per year each December 31, beginning December 31, 2024, the end of this year, and continuing for the rest of her life. We're going to assume that Miss Moore will pass away at 92 years of age or 30 years from now, and that the fund is expected to earn an average rate of 8% return on investment. What is the expected present value of her stream of pension payments as of the first day of her retirement? And there's your check figure. Use it only to say that you got it right after you did the case. And if you haven't already worked the case, go ahead and pause the video and do so. Give you a moment to pause if indeed you were doing so. All right. Okay, welcome back. So this one, we're looking for the present value of a stream of payments. The payment being $100,000 for 30 years at 8%. This is a table factor. So let's go to the present value of ordinary annuity table. And we want to be in the 8% column in the 30th year. So down the columns is years, and then we want the 30 years. The rows is 30 years, is row 30 for the row for 30 years, and the column for 8%. And the value is 11.25778. And so that $100,000 per year, if indeed Jane does live the 30 years and receives the 30 payments, the present value of her pension plan at her retirement is $1,125,778. Solved via the financial calculator, we have these keystrokes. $100,000 is the payment, 30 years, 8 interest per year, 8%. Compute present value. Finally, we have using Excel. There's the answer that this set of keystrokes returned. I could have gone just equal PV and then put minus, but this time this is her inflows, and I wanted it to return a positive value. But what it means is that if you return a negative value, it makes sense because that's what you would have needed to put into an account today to fund 30 $100,000 payments. Anyway, so equals PV, the rate is 8%, the number of periods is 30, the annual payment is 100,000, the future value is 0, there will not be a big payment at the end, and then the type is ordinary, and that's the type of the annuity payment, the $100,000 payment. It occurs at the end of every year. And that's using Excel. Let's go forward to case 3. And of course, pause the video if you have not worked this. All right, welcome back. Gentry Group is considering an investment in a 10-year, $1 million bond to be issued by Netflix Corporation on January 1, 2024. The Netflix Corporation bond has a stated rate of 6%, so it'll pay $60,000 per year, and that'll be paid on December 31 of each year for the 10 years. The bond matures on December 31, 2033. You can count the years there. Given the current macroeconomic conditions and the relative riskiness of a debt investment in Netflix, Gentry Group's CFO requires that the bond yield 10% return on investment in order to make the investment. What that means is that, well, government securities are paying X, so we need this much more than whatever government securities are paying, and we decided it was 10%. Let's say government securities are paying 4. Well, we need 6% more to compensate us for the risk associated with a corporate bond. And of course, government securities are also tax-free, so there's that. You'll learn that in investments class. What is the maximum amount that Gentry Group should be willing to pay for the bond in order to yield 10% return on investment? Hint, if you use tables, calculate the present value of the interest annuity stream, and then calculate the present value of the $1 million maturity value to be received in 10 years. You learned that in an earlier example because it's the same thing. There's that check figure, and there is the process. There is the values when I did the work. It was the present value of the principal is 1 million multiplied by the, again, let's write it in, table factor. For $1 million sum, 10 years from now at 10%. %, 10 years, 0.38554. There it is. And so we are willing to pay $385,540 to receive $1 million from Netflix in 10 years. What are we willing to pay for Netflix to pay us $60,000 a year for 10 years? So it's going to be a total of $600,000 paid over 10 years. Well, we're willing to pay, we go to the present value of an ordinary annuity, again, 10%, 10 years, 6.14457. And when you multiply the table factor, for a present value of an annuity for 10 years at 10%, you multiply that times the amount of the annuity, the payment, and you get $368,674.20. That's what we are willing to pay for the $600,000 of interest payments made over the 10 years at the end of every year, $60,000 a year. And so for both, we're willing to pay the sum of 385,540 and 368,674.20, or 754,217.20. Again, rounding error there. Remember, this was a little easier on the financial calculator. It was one step. 1 million is the future value. 60,000 is the payment. 10 years. 10 interest per year. Compute present value. And while we're here, I'll tell you that if this were an annuity due, you don't say compute, you use the due button, D-U-E, due present value, and it'll give you the present value of an annuity due. All right, finally, here's how we would solve this in Excel. There's that same answer. Equals the present value. The rate is 10%. The number of periods is 10 years. The payment is 60,000 per year. The future value, the maturity value, is $1 million. The type for those payments, those interest payments, they're annuity, ordinary annuities. So we use 0. And that if you type this in the cell, use the present value function, absent the quotation marks, it'll return that value. That's what we're willing to pay today for the cash flows associated with this bond. All right. Once again, I've given you a couple more practice concepts, and I put the check figures in there. The first one is just another case of what's the internal rate of return, given that we actually paid $705,538.40 for the bond. And then this is the same question you've done earlier, but yielding 8%. How much would you have to invest every year? All right, so good luck with that. And I hope this was a helpful look at the important concepts associated with time value of money. Again, as I said up front in the first video, I enjoy these little puzzles. So feel free to ask me anything about any question you might have about present value, time value money concepts or investments or anything else. Have a great day.